Beautiful weather, huh?
Yeah, gorgeous.
That reminds me of Dubai.
Really?
I was just out there a few weeks ago. The Sultan of Abu Dhabi flew me out there in his private jet.
You know him?
Friend of a friend. I met him in Vegas.
He's pretty wealthy, right?
You know how they make those lists? The world's wealthiest people?
Yeah, like Bill Gates is #1 or...
Used to be. Sultan. He's got $100 million in a Swiss bank account. You can't touch it.
Why not?
It's $10,000 just to get the paperwork done.
Okay, well, I think he's got $10,000.
Can't do it. It's illegal to use your own money.
Of course. Red tape.
So I'm like, Sultan, listen, I'll invest $2,500. I'm sure I can get some guys to pitch in $2,500 as well. Okay, we'll get the $10,000, you get your money, you go on your merry way. He was so moved by my compassion that he said, I'll split the $100 million, half for the investors, half for himself.
Half of $100 million. That's 50. That's $50 million.
Is it? I don't really pay attention to the money. I'm just trying to help a friend out, you know? Here's the crazy thing now. We just need one more guy to pitch in $2,500.
Dude, that's me. I'm the guy. No. I can do that. Yeah.
I barely know you. No. I don't want to oppose.
No. Hey, let me call my wife. Hey, I'll clear it with her.
Wish there was time.
What do you mean?
I have to have the money by 6 p.m. when the whole deal's off.
That's in like 3 minutes.
You know, I'm sorry for bringing this up.
Wait,
I don't mean to oppose.
Oh, no.
Thank you. It's nice to meet you.
Who do I wire the money to?
Are you looking for practical investment advice? Do you want to avoid getting scammed and taken advantage of financially? On today's show, we interview the best-selling author of the book, Money for the Rest of Us. Today's guest, David Stein, joins us today to share practical tips that you can use to master successful investing while breaking down his new book, Money for the Rest of Us. You see, David Stein knows his stuff when he starts talking about money. This guy was a former billion-dollar fund manager, and he joins you today to teach you how to invest like a boss.
Like a boss, like a boss. Like a boss, like a boss.
Get ready to enter the Thrive Time Show.
We started from the bottom, now we here. We started from the bottom, and we'll show you how to get here. Started from the bottom, now we here. We started from the bottom, now we here.
We started from the bottom, now we're on the top, teaching you the systems to get what we got. Cutting Dixon's on the hooks, I break down the books. Z's bringing some wisdom and the good looks. As the father of 5, that's why I'm alive. So if you see my wife and kids, please tell them hi. It's the C and Z up on your radio, and now 3, 2, 1, here we go.
We started from the bottom, now we here. We started from the bottom.
Yes, and yes. Dr. Z, it is ecstasy when you are next to me, my friend. How are you doing?
Ditto, right back at you. I'm doing fantastic. You know, I love the line where I say it every time. Oh. If I were doing any better, I'd be twins.
That's impressive.
Yeah.
Now, Z, you know, I've often considered you mentally. I've never said it out loud, but I've considered you to be sort of a financial Sulu. You know, from Star Trek. You know, where Sulu's the one. Apparently, Captain Kirk he's too busy, had too much going on. He couldn't get up and hit the warp drive button.
Well, why?
So he's like, Sulu, let's go to warp. And Sulu's like sitting 4 feet in front of him. He hits the button. Shoo. And Z, as an owner of a bank, I think you are a financial Sulu. But you've been one-upped, because on today's show, we have a financial guru, David Stein, on the line. David, how are you, sir?
Wonderful. Thanks for having me.
Hey, I know that you don't want me to describe you as a guru because you know, you're a humble man. But I want to read off some facts, and if these facts don't appear to be accurate, you can point out that they're not facts. Here we go. You've managed billions of dollars professionally for institutional clients and even co-led a large investment research team. Is that true?
Yeah, that's true. I did that for 17 years.
Oh, wow. So what does that look like when you're managing large institutional funds? What kind of institutions are entrusting their money with you?
It was mostly endowments and foundations, so college, universities, some private foundations, and that's what our firm did. And it looks like stress. That's what it looks like, because you're interacting with boards, investment committees, and they expect you to do a good job. And so there's a little bit of stress with that. And I left that 7 years ago because I was tired of the stress.
So let's talk about the stress, just so some of the listeners can get this. I want to get into a day in the life of your career at that point. When you're managing billions of dollars and the market has a correction or a particular company's stocks tank, how does that go over? I mean, do you get just 17,000 emails saying, "What's going on there, Steiner?" I mean, what how does that look?
Well, in the institutional space, it's all a relative game. So a university cares about whether they're doing as well as their peers and whether they're outperforming a particular index or target benchmark. So it's surprisingly, now if the stock market falls 30%, there's some concern. But if it's down 5 to 10%, these are very long-term investors. They understand that. What they don't want to have happen is they're down 5 to 10%, and the benchmark that we're comparing against is only down 4%. And so they underperform. And so that's where when I talk about stress, I mean, markets go up and down, that I'm comfortable with. It's the ongoing, did you outperform your benchmark this week? What are you going to do that? Because your typical client expects money managers to be able to predict the future accurately. And predicting the future accurately is a near impossibility.
True that.
When it comes to investing.
David, just had a sidebar. What was your biggest home run in those 17 years of being a money man? I mean, what was the one that you said that was a good day?
Oh, yeah.
And what was your biggest home run? Do you recall?
Well, I mean, we didn't buy individual stocks, so we were asset allocators. So we were allocating to emerging markets or different just elements of particular segments of the market. So it's hard to say this was a home run. I mean, I could say that the first 5 years were great because we outperformed every single year, attracted a lot of assets. The hardest part is really going into the financial crisis, 2007, 2008. We were positioned defensively, but our clients still lost 25% of their assets in 2008, 2009, early 2009.
Sure.
And that was a very challenging time.
Sure. Yeah.
Well, what I want to do before I get into what you're doing now is I want to ask you two questions. It might seem like Captain Obvious to you, but for a lot of our listeners who own businesses, they might not be aware of these things. Can you explain in layman's terms so that I can get it? What caused the financial crisis? Just so people understand that. What fundamentally caused that house of cards to collapse?
Fear and greed. So, I mean, the crisis was driven by, at the core, is driven by greed in the sense that people were out buying houses, often not having income. And so you had a clear housing bubble. And then you had financial assets, we won't get into the details, but specific bonds tied to the performance of that housing. And you had a lot of people that borrowed money to invest in the securities that were tied to housing. And so when it became clear that housing prices could actually fall nationally, then you started to have some of the securities that were tied to it begin to underperform. And then you had all-out panic because it was all interconnected, but at its core tied to housing. And then once that switch flipped, then people wanted to get out. They want to get out of their house. They want to get out of the securities that were tied to houses, and everything kind of went down together, just as everybody raced to the exits to try to preserve their capital, and that's what caused it. And then ultimately that led to a very deep recession because people lost so much money, and they wanted to save a lot more and not spend so much because of the hit they took to their net worths.
Years ago, I read Snowball by Warren Buffett twice. After highlighting it the first time, I thought, I got to go back in here and read this thing again. Phenomenal book, his autobiography. And then that led me to read The Intelligent Investor by Graham. Can you explain what makes Warren Buffett such a financial wizard in your mind?
Well, he's patient as an investor. He has a specific discipline that he pursues. He's a value investor. And I actually talk about this in my book, both Benjamin Graham and Warren Buffett. And when you're a value investor and you're buying an individual stock, your thesis is you're right and the stock is mispriced. and the market is wrong. And they have been very, very good as investors identifying those mispriced stocks and being patient and waiting the 7 to 10 years for that value to be realized. What people don't realize, it's much more difficult, even for Warren Buffett today, given the technology, the interconnectedness of markets, the bots and algorithms that drive markets, to identify mispriced securities. And so when you actually look at Berkshire Hathaway's performance over the last decade or so, it's not actually outperformed the S&P because they have so much cash that they've not been able to put it to work in finding these undervalued opportunities. And that's where investing gets more difficult when our success is dependent on outsmarting other investors, when all those other investors are getting smarter and smarter as the years go on.
So what I love about the title of your book is it's called Money for the Rest of Us. Because I think a lot of people, Z, where we read Forbes, the Forbes list, entrepreneurs, and you go, oh man, Warren Buffett, that's awesome. But then you're going, yeah, but what about for the rest of us? What about for me? Like, let's talk about your book. What inspired you to write this book, David, Money for the Rest of Us?
Well, the subtitle is 10 Questions to Master Successful Investing. And what I found frustrating is seeing new investors or even experienced investors really go down the wrong rabbit hole. They might decide that they want to trade securities, as opposed to being long-term investors, or they get caught up in cryptocurrencies or real estate investing. And there was a lot of very good basic investing books, but no one was really taking a step back and saying, well, here's a checklist of things that I should answer before I invest in a particular opportunity. Decide, well, question one is to simply, what is it? To be able to explain in simple terms to a family member, here is how this investment works. Because sometimes investing is exciting, and sometimes we get so thrilled about making money investing that we don't really step back and try to explain, well, how does this actually work? How does Bitcoin actually work that I can make money at it 3-5 years down the road? And that was really the genesis of it, just having a framework, a discipline that we can use to make decisions. And Annie Duke, who wrote Thinking in Bets, endorsed the book. And one of the reasons she felt it was a very good framework for making any type of decisions. And she's a decision strategist, and mentions that, a successful decision isn't because it has a good outcome. Sometimes the outcome isn't what we want, but if we have a good process, then it was a good decision. And that's an important component, having that framework to make good decisions.
Z, as I was preparing for this interview, I made kind of a pithy, a quippy title that I feel is ultra sexy, and this is really going to help sell this book here, my friend. Here we go.
Oh, good. Oh, yeah.
It's now time for Deep Thoughts from David Stein that will blow your mind. What do you think about that, Z? Does that work?
I think it's sexy. I'd buy it.
Okay, here we go.
I'd buy 2 copies
you
right
have,
now.
You have a lot of deep thoughts in your book here, Money for the Rest of Us, but I would like to hit on 3 in particular here. If you can't explain it, don't invest. What does that mean?
Well, that comes from one of my institutional clients with a college foundation. He had about $200 million, and the head of the committee, the investment committee, that's what he told me, is if I can't explain an investment to somebody that's not on the committee, then we shouldn't invest. And the academic research, what it shows is just the act of explaining something, as simple as how a zipper works. Once we try putting words to explaining it, it humbles us. And so by explaining it, we realize, well, there's some things we might not know. And so we're less likely to go, sell all our assets and go buy Bitcoin because we think this is a great opportunity. Or a guy I mentioned in the book, a furniture salesman, that was way more excited about trading options and futures and learning how to do that than selling furniture, had never saved his entire life. He had a defined contribution plan or 401k plan. He could have got 100% return with the match. And yet now he's 65. He doesn't have any savings. So he pays a trading academy $25,000 to learn how to trade options and futures. Now, that's crazy. In fact, I went to that same academy and sat through a 4-hour class so I could figure out how could they convince somebody like this to pay $25,000 to learn how to trade.
Jeez.
And they were very upfront when it comes to trading. They actually had a patent, and you can go to the patent office, and I looked it up, and their patent says successful traders exploit naive traders. And this whole trading academy and all these people trying to learn how to trade, they're being exploited.
Oh, true.
And so the other reason to write this book is to keep people so that they don't get exploited. They can focus on things that actually work when it comes to investing.
Let's talk about the math and emotion of investing. The math and emotion of investing. You write about it in your book. Break it down for us.
Well, with all investing, there's rules of thumb. So simple things that we can follow. We don't have to be an expert to be a good investor. We just need to understand the underlying principles. And when we talk about the math, there's really three things that drive all asset class returns, be it stocks, bonds, real estate. The first is the cash flow. So how much income are you getting, be it interest, dividends, rent? That's the first driver. The second is, how is that cash flow growing over time? Is rent increasing? Are earnings going up? Are dividends going up? And those two components, that's just math. You have what the income stream is, and you have how fast it's growing. That's a big component of the returns. The third is the emotion. What are investors paying for that cash flow and that cash flow growth? And within the stock market, that's sometimes called the PE ratio or the price to earnings ratio. But what are investors paying for that earnings? And that tends to vary much more than the income and the income growth or the cash flow growth. What people are willing to pay. And so you gave the example of the financial crisis.
Yep.
Coming out of the financial crisis of 2009, people didn't want stocks at all.
Yep.
Or not as much. And so they were the cash flow, the multiple they were willing to pay was very, very inexpensive. And it was a great time to buy because the less people are willing to pay, the higher the expected return as long as that income and that cash flow is there. And that's exactly what happened, is why a decade later, the U.S. stock market has returned 12% annualized. If we look at where we are today, we're not going to get 12% over the next decade because we're already very high valuations, which means the workhorse of our portfolios over the next decade is going to be the dividends, the cash flow, and how fast it grows. And the thing about the stock market is the cash flows don't grow any faster than the economy grows. And the economy in the U.S., around the world, doesn't grow very fast, 4 to 5% a year.
Sure. That's a good growth, right? Yeah.
Right. And you got 2% dividends. So, a baseline assumption for stocks over the next decade is about 6% per year.
What I want to do now, Z, are you ready to get stupid?
Is that
well, I feel like we need to really, really, really break this down. Because I think we have listeners out there right now who are experts in fitness, who are experts in plumbing, experts in photography. They're like a genius in that area. But then we get into like finances or home repair or something that we're not familiar with, and all of a sudden we're kind of stupid. We're all stupid in some area.
Oh, that's true.
I'll be the first one to say, whenever you start talking about your horses, Z, the competitive horses that you raise and race, I immediately go, I don't know what that means.
I don't know what that means.
You'll say words like, well, Clay, the horses, you'll say like, Clay, you're like a horse with blinders. And I'm going, blinders? Blinders? What does that mean? And then now I'm more familiar with it, but so now I'm like a first grader in the world of equestrian things. But again, we all have to start off at a place of kind of a very simple knowledge. So let's do this. Z. Let's get really stupid. I'm going to ask some basic questions that I think are some listeners might say, Clay, that's a stupid question. But and then Charles, I give you permission to ask stupid questions if you want. And Z, you could ask them as well, or you could ask smart ones. But I want to ask questions that I would want to know if I knew nothing about investing. So here's my first question. Where do people need to start? Where does the plumber need to start right now? The plumber made $100,000 of profit last year. $100,000 is left in the bank account after he paid himself a salary of $80,000. He paid himself a salary of $80,000. He's got $100,000 left in that bank account of profits. Where should he invest that, and how can he minimize his taxes? How can he do it?
Well, he should invest it in cash. Assuming that he doesn't have any savings, just start out with the emergency fund. Once you have the emergency fund, be it several $1,000s, then open an account at a brokerage account, or you can use an app like Robinhood, and you really need only two holdings. You can buy one stock exchange traded fund, which is a commingled vehicle. For example, the Vanguard Global Stock ETF, total stock market ETF. The ticker symbol's VT, and that owns the entire world. So it has close to 10,000 holdings. It has U.S., it has non-U.S., and that's your stock allocation. And then you can you can either use, if you're at Vanguard, you can use a cash fund. And starting out, you really only need two funds. You need a stock fund, and given where interest rates are right now, you just need a cash fund. And the way to approach it is, well, how much do I put in a stock fund versus a cash fund? Well, stocks, as we saw in 2008, can lose 60%. Now, it's okay if stocks lose money. That's just because in most of those losses, certainly it's because investors aren't willing to pay as much. But risk is not losing money. Risk is the personal financial harm that comes from losing money. Well, if this is a young plumber and doesn't have to access that money for 30 years, then they can put more in stocks. But if they're going to retire in 3 years, then they need to say, all right, I'm not really comfortable losing 60% of my assets. Maybe I only want to put a half in stocks. And then if the stock market falls 60%, then my portfolio only loses 30%. But to start out, the biggest thing is just actually do the savings, and you can buy one of the two ETFs. You got your stock allocation, you have cash, and you're set to go. And then over time, as you learn more about investing, then you can add other options. But that's all it really takes.
Z, I have one more question for David before I flip it to you, and then we'll go to Amber and Charles Kolaw here. Let's say that I own a business with 3 locations and soon to be 4, and I find myself being pretty profitable. And I meet with my accountant or somebody who's my accountant, somebody who's my financial coach, and I discover, I owe a lot of money. You know what I mean? Let's say I'm somebody out there, I own maybe 4 restaurants, 5 restaurants. I'm doing well, and all of a sudden I get to that final quarter of the year and I go, man, I owe a lot of money in taxes. What steps does somebody need to do to not end up in that situation again? And what kind of role should their accountant have in advising them so they don't end up in that situation proactively?
Well, as a U.S.-based investor, there's only so much you can do. I mean, you can set up and work with your accountant to set up. You have your 401k, you can have a profit-sharing plan, but the IRS limits, I believe, the maximum you can defer and not pay taxes on and put it in investment accounts about $40,000 to $50,000 per year. So above that, you're going to pay taxes. And I tell investors all the time, paying taxes is just part of investing. If you have to pay taxes as an investor, it means you are a successful investor. Now, you try to minimize them by owning exchange-traded funds or funds that have very low turnover, so they're not trading a bunch of stocks and generating gains. And you try not to move in and out too much, but you be a long-term holder. But at the end of the day, you're going to pay taxes. And if you're a restaurant owner making that kind of money, you don't want all that money in tax-deferred accounts because you might want to retire early, in which case you're going to want money that you're not going to get penalized for withdrawing. You want some taxable assets that you can invest in a tax-efficient way so that you have something to live on if you decide to retire when you're 50.
Z, I think there's somebody out there who's taking notes right now. And Z, you started off as an optometrist. Well, first off, you started off as a dishwasher.
Yes.
And you were a phenomenal dishwasher at Chiquita O'Brien's?
I don't want to toot my own horn. I was 13 years old, and I mean, those dishes came out clean. High and tight, baby. We were high
You were good.
Tight.
And you rode that momentum into becoming an optometrist. And at some point, I'm going to say age maybe 30. You can correct me if I'm wrong. At some point, you woke up and said, ooh, I have some money now. What age did you have the thought, you know what, I'm doing okay now? What age was that where you thought, you know what?
Probably right around 30.
Around 30.
Yeah.
So let's put on the hat here. Let's pretend that you're 30. You're into that Beverly Hillbillies kind of phase of your life, Z, where you finally come into that money. That Arab money, Z. You know what I mean? You've been working hard. You've been delaying gratification. You're finally coming into some money, Z. What questions would you have for David if you were right there in that phase of your life before you became the guru?
He answered some of them. I mean, a lot of it is where you get started. And I think having a good mutual fund, I think that's what Vanguard is, right? Would you call that a mutual fund, David?
Well, Vanguard would be a brokerage. So they have mutual funds and they have exchange-traded funds. And so I gave an example of one of their specific holdings, VT, which is a global stock
very good.
Fund.
Yeah, because that was one of the first ones I did. I did some Vanguard, and I would do some. I thought, well, these guys are smarter than me, so I would give it to investors in the form of that, and they would go and invest it, and mix my money with my little paltry amount with somebody else's. Next thing you know, you've got $1 billion there you're playing with, and you can really do some fun stuff with that. My big question for you, David, would you break down? So many people out there, they're listening right now, are so confused about cryptocurrency.
Crypto.
What in the world is cryptocurrency, and why do I hear all these crazy stories about cryptocurrency? And is it something that you would ever advise someone to invest in? And if you do, why not? Just kind of deep dive a little bit on that, please.
For sure. So one of the questions in my book, question 2, is it investing, speculating, or gambling? And I've already explained what investing is. Investing is something that has a positive expected return because there's cash flow.
Right.
There's the income and there's the income growth.
Right.
Speculation is something where there's a disagreement whether the return will be positive or negative because there's no cash flow. And an example of a speculation would be gold, antiques. I mean, things only go up in price if somebody's willing to pay more.
Perfect. Yes.
Cryptocurrency, Bitcoin, Ethereum, those are speculations. And so and the thing about speculation, there isn't a correct price. It's worth whatever people are willing to pay, which is why you saw Bitcoin in 2017 go from $3,000 up to $20,000 because it's not tied to any cash flow. You can't say Bitcoin's too expensive relative to the earnings because there is no earnings. All Bitcoin is and other cryptocurrencies is they're just essentially spreadsheets in the sky. They're transactions. It's just it's called what's what the blockchain is. It's just a record of how Bitcoin has been passed on from one person to the other. And so it's an excellent tool if you just want to send some money to somebody. It can happen very quickly. It can happen generally anonymously. And so you have this ability to send money as opposed to having to go to a bank and try to wire it or PayPal. And so that's what it is. Now, it's gotten popular because of the way that there's this record, and there's a limited number of Bitcoins that will ever be created. And it's run by an algorithm. It's just out, and we don't have to get into the details how that works. But people get excited because they say, well, Bitcoin's going to go up in price because there's only so much of it. But like most speculations, Bitcoin and other cryptocurrencies depend on trust. Do people believe it will be worth something 20 years from now? Now, for gold, which is a speculation, we could say, yeah, probably. It's been around thousands of years. It's shiny. It's pretty. People have used it. Bitcoin is sometimes called digital gold. It's got an algorithm that drives it. I haven't looked recently. I might own it, but it's probably $7,000 per Bitcoin. And that is sort of what people think it's worth now. And they own it because they think it's going to be worth more in the future. But it's clearly a speculation. And my belief is speculations in individuals' portfolios should be less than 10% of their assets.
Okay, there we go.
It's fine to take a flyer, but what I get worried is people that think Bitcoin's the next great thing, and then they start putting 50 to 80% of their money in it. The thing about speculations is you go into any speculation, you go in assuming you're going to lose all the money. So just assume it's gone, and that helps you scale your position. So you only put enough in that you're willing to lose if you lose it all.
Z, dictators love Bitcoin.
They do?
No, seriously. I was reading about this. With our good friends in North Korea, our good buddies. Dennis Rodman's good friends with the North Koreans, and these guys are driving around Mercedes-Benz. They're Mercedes, but they're not allowed to buy them. You know what I mean? That's the rule with the sanctions we have. The North Koreans can't be buying some of these vehicles, but they always have them. So with the Bitcoin, you can buy. Can you explain, David, how you can buy stuff anonymously using Bitcoin? Can you kind of explain how that works?
Well, there's a public every Bitcoin holder. There's a public and private key, and using an app, you just basically transfer it to the person. It gets added to the blockchain, and if you trust somebody to send you the Mercedes, you send them the Bitcoin that you own. And, you can store the Bitcoin on your phone in an app, or you can store it other ways. And that's just transfer it, and then they send you the goods.
Oh, dictators love it.
Now, there's no name attached to that public and private key. Now, there's some controversy whether it can be found out based on the transaction history, but generally speaking, it's fairly anonymous, except that you have to get the Bitcoin to begin with. So most people want to go to an exchange such as Coinbase and take dollars and convert them to Bitcoin. Well, once you do that, then the Coinbase or these other brokers, they have your information because the U.S. government requires it. So the key is to get the Bitcoin without registering for it at some broker. We have to give all your information.
Okay, now Charles Kolaw, you and your wife are the founders of KolawFitness.com. It's a business, David, that he and his wife started in a $115,000 house in Bartlesville, Oklahoma. They started training clients around the clock, one-on-one clients. Amber had a hair salon business. Charles is doing personal training. Now they have 3 big box gyms, and they're en route to opening their 4th and 5th right now. They're having a lot of success. Charles, what questions do you have for the financial guru, David Stein?
All right, David. Yes, like Clay just introduced us, I am not into financial investing. I do have an MBA with the emphasis in finance and accounting, but you learn a lot more when you actually get out and start learning about stuff. What, far as in, like you said, investing into stocks, what are some of the historic returns on stocks historically?
Well, the U.S. stock market historically, if you go back to 1900, has returned 9% annualized, about 9.5%. And we can go back to what generated that return. 4 percentage points came from dividends. So just the profits and the stocks paying out a share of the profits to the shareholders. Another 5% came from the earnings growth in terms of those dividends growing over time.
Yep.
And another 0.5% came from people willing to pay more for stocks today versus what they wanted to pay in 1900.
Okay.
And so when we talk about investing going forward, we can use those same 3 drivers.
Yep.
Dividends, as I mentioned, are 2%.
Okay.
If earnings grow 5%, then we're at a 7% return. And if we assume stocks don't get more expensive over the next decade, then we can assume about a 7% return. And that's kind of, if you're saving for retirement, I would assume that stocks earn 6 to 7%. Now, if you're earning more of that in your business or another opportunity, then
yes,
that potentially is an attractive investment, because your baseline is you're going to earn 2% in bonds right now, given what interest rates are. You're going to earn 6 to 7% in stocks. And so then the idea is you have to save a lot more unless you generate a cash flow generating business, which sounds like that's what you have. And that's where the true wealth is going to be made. People don't make money. You don't get rich investing in the stock market.
Gotcha.
Most investors got rich because they own a business.
Perfect.
And hedge funds, they're wealthy not because they're brilliant investors. They're wealthy because they own hedge funds. And they get 20% of the profits each year that goes into their bank account.
Great.
Very few investors actually got wealthy because of their actual investing returns.
Good to know. What is the current returns this last, say, 5 years? I know that we've kind of been coming back a little bit, but what's the current stock?
Well, I mean, I can tell you last year it was probably close to that 10% number. The stock market was up 30% last year, the U.S. stock market in 2019. And that's a great example, because last year dividends were 2%. There was no earnings growth. And so all that appreciation, most of it came from stocks getting more expensive between December 2018 and December 2019. People were willing to pay more because they got more excited because they decided the recession wasn't coming. Whereas at the beginning of 2019, they thought the recession was coming any day. So I'd have to pull up the prior 4 years, but generally, once you get that 30% kick, that certainly helped. I can tell you over the last decade, they did 12%. Global stocks did 9%. But going forward, because we're at a much higher valuation, returns are going to be lower.
Well, yeah, I was going to say forecasting for the next 3 years. What would you say?
Predicting the future. Here we go. Here we go.
Sorry.
Yeah, I don't.
You don't do that.
It's very, very difficult to forecast a 3-year time horizon.
So maybe
you can do a 10-year and get a pretty good estimate. And and it's not that we're just trying to have reasonable expectations.
Got it.
And that's what I've given. This is reasonable.
Okay.
Now, 10 years from now, because what concerns me is like people will quit their job and say, I'm retired.
Oh, yeah.
And they assume that their stock portfolio is going to do like it has done historically, 10% per year, without understanding what drives the returns.
Uh-oh.
And so that's all we're trying to do is like what drives it so that I don't make a foolish assumption and assume history will repeat itself, because it won't. There are fundamental rules, and that's why we talked about the math of investing and the emotion. Those are the drivers. We need to at least understand them, and we don't have to be an expert to do so.
David, we have time for two more questions. I have a question here for you. What are you doing now as a career? Somebody who says, you know what, I'm going to buy this book. I'm going to pick up Money for the Rest of Us. I'm going to buy the book. Obviously, you're an author. Obviously, you have previously managed billions of dollars of investment capital there. You've written this book, Money for the Rest of Us. If our listeners out there buy the book, can they hire you to help them? Do you do that? I mean, are you available to help people, or not so much?
Yeah, so I'm no longer a registered investment advisor, so I do not give individual advice. What I do is I provide investment education. So I have a book. I do a free weekly podcast called Money for the Rest of Us, where we talk about how money works, how the investing works. And then I also have a premium membership community with about 1,000 paying members that want even more guidance. There's model portfolios on there. I show what I'm doing with my investment portfolio. And so what I do is I give people peace of mind when it comes to investing. So they feel like, hey, I can do this. This is not as hard as it seems like it might be once you understand the principles of investing.
What does it cost for your online community, and what's the web address for that?
So the cost is $300 per year.
Oh, wow.
There's also a monthly option. So, I mean, and it's
great deal.
It's a reasonable price given, I used to charge clients $50,000 to $100,000 per year. So, $300 for an individual is much lower.
No, that's great.
And you can get more information on that in the podcast and the book at moneyfortherestofus.com.
Z, one thing I wanted to, this is my final question I have for David here, and feel free, Z, if you want to one-up me or Charles, but this is my final question. I was reading Warren Buffett's book, Snowball, and he said, and I'm paraphrasing, but if we look up the quote here, Devin, you can look it up here. He says, be greedy when the market is fearful. He says, be greedy when the market is fearful. So like I got my highlighter, and I'm like, okay, I got this. He says, be fearful when others are greedy, and greedy when others are fearful. And I'm going, wait. Be greedy. And then it occurred to me, I get it. When people want to sell because they're having a desperate financial situation, that's when I should buy. So Vanessa and I have made some pretty good money buying houses from people that are, getting divorced or having some life issues. And I'm like, oh, what kind of life issues are you having? Oh, this could probably be a good deal. I mean, that's kind of how you have to think,
Sure.
And Warren Buffett talks about that. But he also talks about how he does not go to New York and go to the stock exchange very much because it's so emotional there. He's like he's the Omaha Oracle. But he controls the stock market while never really going to the New York Stock Exchange very much. And one of the things he talks about in his book is how just little things like a celebrity endorsement, Z, can make the stock go way the heck up. And Z, you and I know this. When you make a little bit of money, you can kind of pay celebrities to say almost anything. So I have a collection of recent things that have been said about me to try to make my stock market go up here.
Oh, there you go. Yeah.
That John has shamelessly paid for. So let me cue up the audio here, and I think you'll get a kick out of these because these are actual audio clips that are they're true. These are the real people are saying.
Hey, wait. Maybe I should buy a part of you before you do that because if
my
your
stock might go up.
I know.
So here we go. I'm going to hit play on this. Here we go.
Hey, Clay Clark. It's your favorite gunslinger, Brett Favre. Just reminding you, you are a great American. I mean great. So keep slinging those Hail Marys.
Now, God bless. Even that's a funny video and it's a real thing that John paid for.
Yeah,
it makes you feel kind of good because I love Brett Favre.
Who did like
and
Brett
John
Favre?
sends me that in my inbox, and I'm like, that's pretty cool.
That's pretty cool.
But at the end of the day, like you and I know, you can pay like Michael Jordan to say this underwear is great. Sugar water, drink it. I'm Michael Jordan. Right?
Oh, yeah.
So it makes you kind of go, oh wow, this person must be more valuable, or that product must be more valuable. But at the end of the day, it's the same person or the product. So there's this emotional part of investing. Help our listeners right now who just heard a shameless Brett Favre endorsement of Clay Clark, and they're going, oh my gosh, he must be real now. I mean, help us take the emotion out of investing here, David. How do we take the emotion out of investing? Help us.
Well, what you do in that particular case, you don't buy Clay Clark.
Oh,
You don't, because
nice.
the reason why is that's a very specific bet on one entity. And what I have found in investing, the more specific the bet, the more likely you're going to be wrong, because something could happen to you that we just don't know.
Yeah.
And so it's better to buy baskets of securities, be a mutual fund where you have, or an ETF where you have thousands of securities. And Buffett is right. Buy when people are fearful. And how do you know they're fearful? Well, the prices are falling, and that's third driver, what people are willing to pay for that cash flow, the price to earnings ratio is very, very low. And so then the lower the PE or the lower the valuation, the higher expected return. And the beauty of buying a basket of securities through an ETF is you don't have to know which particular security is going to surprise to the upside. You just know it's like having a popcorn, unpopped popcorn. You put popcorn on a heat source, it will pop. You don't know which kernel is going to pop first. You don't have to predict that. You just know that it is. So if you buy an asset class that's cheap, where people are selling indiscriminately because they can't take the pain of losing money, you know that it is embedded with a lot of positive surprises. And it doesn't have to be a specific bet on one company. You own thousands of companies, and that's how you'll make money over time.
Oh, this guy, he is David, you are a laser show. You are just, and by the way, if you Google David, have you ever thought about David? I mean, is your fallback position being a male model? Have you ever thought about that?
No, not at my age.
Or maybe just a hand model. I don't know. It's pretty.
There you go.
That's a beautiful thing there. Z, do you have a final question for David before we allow Charles to hit him with a final tough question?
Oh, yeah.
How can we get your book? Where do you want us to go and get your book?
Yeah, we want to get the book.
This is the book that everybody needs, because we're all out here as successful entrepreneurs with extra cash. And now we're kind of going, okay,
Devin,
I know how to make it. I know how to make it. But now the other game is, this whole game of trying to take what I have and let it and do the best I can with it. Grow it however I think is going to be the best way.
I'm buying it right now on Amazon. Where's the best place to buy it?
Well, Amazon has the hardcover version. There's a ebook Kindle version.
Yeah.
And there's an audio version through Audible, so you can get the audiobook. It's on Amazon, Barnes & Noble. And if it's not at your local bookstore and you buy from your local bookstore, then tell them they should get you a copy.
David, did you do the audio version? Did you actually read it?
I did.
Oh, you did? Really? Oh, so we could hear your voice.
Oh,
wow, that's
beautiful.
Cool. Oh, that's beautiful.
Well, yeah, because I've done a podcast for 6 years, they were my words. It would just make way more sense for me to read my own book.
Well, sure, no. I mean, a lot of people don't because they're thinking,
well, if you can't, my rule is if you can't have David Stein read your book, you want Morgan Freeman.
Well, yeah.
That's the backup.
That's
plan.
the backup. That's plan
yeah,
B.
exactly, and he wasn't available.
Okay.
Oh well,
beautiful.
That's too bad.
Charles, we have time for one more question for David.
Perfect. Okay, I was going to say, David. Of course, we have 3 multi-million-dollar gyms in 3 different states, and we're getting ready to do 2 more. And we've got a model that I think is really, really competitive against some of these major players, and we're actually winning. And I'm really wanting to grow that and scale it. And as far as in like getting investors to invest in that, or like, is there like a corporate non-voting stock thing that you can do, or what's the best way to try to, if we're trying to grow faster than build 2 or 3 clubs every year,
and not work with a bank, you're saying,
and not work with a bank, but
okay,
maybe be able to grow a little faster, where some people want to make, a 30% return on some sort of targeted thing or whatever. My goal is to try to grow, but not have to, every single time, go to the bank and so on. So what's your thoughts to some of that, corporately trying to grow without losing control of everything?
Well, when you take outside investors, you're going to lose some control. And that's particularly if you take venture capital money, because what you have now is great, right? Because you have what's known as a lifestyle business. You enjoy it. You're making money. Once you start bringing in outside money, they want 30% returns. And I mean, if you get friends and family, you can get investing. But, at the scale that you're talking, you're probably going to need institutional money, in which case they're going to want to have some say on what's going on.
There it is.
And there are many founders that lost control of their company because they took outside money. And now that you have control, I would be hesitant to grow that fast. I mean, it depends on what you want. I mean, I've done
No,
some
that's good to
consulting
know. I'd like
with business on that, and we were talking about that recently.
Yeah.
And it kind of depends on what you want to be. And there's a great podcast called, I'm going to forget the name of it right now, but they were having this question. It was actually a podcasting company that they had started, and they wanted to take outside money. And the guy said, Alex Bloomberg, well, I just want a nice business that's going well. And the venture capitalist says, that's great, a lifestyle business. You're just not going to do it with my money, because outside investors, they want control and they want to make sure they get the return because they have investors that have invested in their particular fund.
True.
So if you're doing well on your own, and I would be hesitant to take outside money just for that loss of control.
And I have my 3 C's. Z. I tell people when you take on capital, you get the 3 C's. You get the capital. That's cool. You get that cash.
Get the cash.
2, you get the counsel. That's feedback, whether you want it or not, from all the people who've invested.
Yeah, sometimes you don't want it. But
and you get their connections, whether you want to or not. If they make a big moral faux pas or they get in trouble or they do something great, you're kind of guilty by association with the 3 C's. There you got the connections, the cash, and you got that counsel. And sometimes that counsel can be a little bit unwanted.
Unwanted. Okay, David, my last question for you. If you could go back 25 years.
Oh, yeah.
And time travel and your DeLorean and sit down with yourself of 25 years ago, what advice would you give yourself?
Oh, wow.
Well, you can compound your wealth, but one of the things you can also compound is your influence. And particularly in today's world, the way you compound influence is create stuff. So I would tell myself 25 years ago, keep creating, keep writing, producing things, sharing it, be of help to people. And over time, that influence grows. And it's particularly relevant to the investment community because so much is like, well, I don't want people to know who I am. I'm just going to hide behind a firm or a company.
Mm-hmm.
And even with this gym that you're operating, right? It's okay. We're in an era where people want to know who they're doing business with. They want to know about them. They don't want some corporate entity that nobody knows who's behind it. They want authenticity. And one way you develop authenticity is you produce content. You get out there, you do videos, you do writing, you share your thoughts. So people, when they Google you, they can find you.
Oh, yeah.
And if they can't find you anymore, then
it's true.
Then that's a problem because then you don't have that trust. And so
it's powerful.
I would tell myself, continue to produce things that would build trust that people have in me, and I'm a service to them by what I produce.
Perfect.
See, you always ask better questions than me, and that's why we have to wrap up the show.
Hot takes.
That's it? Okay.
I know.
Well, it's been a fun show.
It's a great show. David Stein, you're blowing our mind.
Come on now.
Boom.
Well, thanks for having me. It's been great.
Yeah.
David, we appreciate you. I hope you have a great rest of your evening. And everybody out there, go pick up a copy of Money for the Rest of Us. Money for the Rest of Us by David Stein. And Devin, I think did we just buy a copy? Did we just buy a copy? We did?
We just bought a copy.
And we bought a copy. And I think we bought a copy. And I think our copy was $16.99.
True.
And it was worth it. I mean, I'm going to have to avoid a regrettable burrito. Or a trip to Starbucks, or I'm going to have to live in financial depravity for at least a third of a day.
Yeah, you're going to have to make some financial choices.
I'm going to have to fast for at least 2 meals tomorrow.
Oh,
I could tell you there's at least $16 worth of value in the book.
Oh,
there you go.
For sure.
Perfect.
That 16.99.
99 cents. That's just the juice. That's just the juice.
So if you're out there and you care about your family's financial health, and you don't know what you're doing with your finances, pick up the book. Pick it up. Don't be a knucklehead. Buy the book.
Or if you just want to be an investing idiot. I mean, because that's half of it. It's kind of like, what do I do? I want to be an idiot. I want to be an idiot. Get the book. Get the book.
Now, if you want to be an idiot, buy as much Bitcoin as possible before you know what you're doing. All right, David Stein, thank you again, my friend.
Thanks, David.
Thank you, David.
All right. Thank you.
And now, without any further ado, 3, 2, 1, boom!
There have always been people who don't believe. They don't believe in hard work. They don't believe in responsibility. Ultimately, they don't believe in themselves. They believe in shortcuts, in luck. They believe that outside circumstances control who succeeds and who doesn't. It's just the luck of the draw. But you are not one of these people. You believe that no matter what your circumstances tell you, success is still possible. And you accept this responsibility because you want to achieve something great. You're hungry for it. You chase it from the moment your eyes open in the early morning. You chase it into all hours of the night when others have given up, when others have said that it couldn't be done. You've kept pushing because you believe that success is not a game of chance. Success is a choice. A choice that you make every single day. That's what you believe.
Discover the world's most affordable and effective business school today at thrivetimeshow.com.